I'm Teresa Bailey, host of In the Money. On today's show, we're talking about the roles that life insurance can play in protecting your family and your financial plan. According to the 2017 Insurance Barometer study by Life Happens and the Life Insurance and Market Research Association, 41% of Americans do not have a life insurance policy. Of those that do have coverage, nearly a third only have a basic group policy through their employer. Joining us today is Mark Wiseman, a business and estate planning consultant with Agency Services Incorporated. Mark's going to share with us his thoughts on how life insurance can impact your family if you die too soon, live too long, or get sick along the way. Stay tuned as we sit down to chat with Mark Wiseman.
You are watching Germantown Municipal Television, your source for everything Germantown.
Today we're discussing how life insurance can factor into protecting your family and your financial plan. Joining us is Mark Wiseman with Agency Services. Thanks for being here today, Mark.
Thank you for having me.
Welcome, welcome. So before we get started, how about you tell us a little bit about yourself and what you do every day?
Well, as you mentioned, our firm, Agency Services, is a second-generation firm, and basically we help banks, wirehouses, broker-dealers, financial advisors, and financial planners to better position their clients when it comes to risk management. And if that incorporates life insurance, disability insurance, or long-term care planning, we do that. And we train them so that when they're sitting down with their clients, they feel good about what they're offering their clients.
So in your experience in doing this, what do you feel is the best approach that we should all take when it comes to evaluating our life insurance?
Well, I think so often our firm sees this situation where just like you have your car in for a tune-up, or you have your house checked on every year, whether it's the heating and cooling services, insurance is no different. It's a financial tool and it should be reviewed on an annual basis. So we encourage financial advisors to do that with their clients, to bring in insurance statements and sit down with them and make sure that the insurance plan is performing to the expectations that they were promised.
Now, when we talk about life insurance, we're really talking about risk, right? And one of the biggest risks that we all think about with life insurance is if we die too soon.
Yes.
So let's talk about a couple maybe in their early 40s. What really should they be focused on with their life insurance?
Well, loved ones. You know, a lot of times they've just started a family in their 30s, possibly their 20s, and the children are approaching education years. They've bought a house or a mortgage. So, you know, I think the question needs to be asked, what happens when the breadwinner or both breadwinners don't come home that night? How are they going to keep making that mortgage payment? How are they going to be paying for that car or funding that college education for that child? And that's where insurance is a tool that steps in and completes that process for the family in a very efficient way. There's really, I mean, if you look at the insurance product at that phase in one's life, that's really creating the estate rather than protecting it.
So that sounds, you know, that concept I think we can all probably understand. You know, that if something happens, then, you know, there'll need to be capital that comes into the household to assist with that expense. But how does someone come to that calculation? How would they know what their total life insurance need should be?
Well, that's where the financial advisor comes into play, and they should be able to sit down and take in all the financial statements, all the debts, obligations that are owed by the family, and really work through a needs analysis for that family and come up with, there's a couple different ways to do that. In fact, you alluded to it in the opening segment. There's a nonprofit organization called lifehappens.org. You can go to that website and actually download tools to help you do an analysis of the needs that are going to be, they're going to need to be in place if that tragedy happens.
So it's really assessing the emotion of who you say I love you to, figuring out what problems would need to be solved that you would not be there to solve, and then doing a little math, it sounds like.
Correct, because it does come down to the numbers. And you know, some of the pushback we get a lot of times with clients is that, you know, I don't want to be overinsured, and we understand that. So you want to make sure you do a proper needs analysis. And you know, if you think about it, a lot of people think that $1 million is a lot of money today, and it is.
Sounds great.
It's a lot of money. But if you've got 40 years to live or 50 years to live, that may not be as much as you think with inflation and other risk out there.
What other things should that couple in their 40s really be taking into account as far as their insurance?
Well, they should be looking at disability coverage because not everything that we have and we own, whether it's the mortgage or the cars or the vacation times, that is being paid for with a paycheck. So we call that paycheck protection. And if you get sick or hurt and you don't have adequate coverage, then the bills keep coming, but there's no salary to pay the bills. So adequate amount of disability insurance is an absolute necessary for young couples in their 40s.
That makes sense. So
Yeah.
what about a couple in their late 50s that's really looking towards retirement?
Well, that's a unique situation that, you know, they have a lot of times they have a nest egg that's been built on and over the years have been saving toward a retirement goal, but they're not there yet, or there's a market correction that we've seen in the last couple of weeks, and that can have an impact on somebody's assets. That's also a generation that we're seeing today is we call the sandwiched generation. They're in between a parent and possibly a child still in college or something. And so they have very distinct and unique requirements to their financial plan. So we really sit down with them and talk to them about the risk of a chronic illness or the risk of a long-term care, because a lot of times they're taking care of a parent at the same time raising a young one.
Now, what things in retirement, you know, they're looking towards pension income, Social Security income. So talk through a little bit about what happens in a financial plan that you've seen when one spouse sort of in the early years in retirement or close to it passes away, maybe Social Security or pension loss. What are some of the big whoops moments that you've seen?
That's a great question. You know, pensions by and large have gone by the wayside. They're still out there. A lot of our, you know, FedEx has a huge impact on our community here in Memphis and the surrounding areas. But a lot of the risk is being shifted over to what we call 401k plans. So in that scenario where there's not a pension involved, all the risk is on you putting money into that plan. If the breadwinner disappears, there's no pension. There's no 401k. So you need adequate amounts of life insurance to accomplish that. Also, if you have two Social Security incomes later in life, one passes, that typically is cut in half. And they don't expect that. So we always encourage to buy at least a policy that will last to the end stage of life. And so that will come in and replace it, give it to the advisor. They can then turn around and invest it to replace that lost Social Security or lost pension.
We'll get back to that. That's a great point. We have to take just a quick break.
Sure.
We'll take that quick break and be back in a moment with Mark. Stay with us.
Most party fouls are pretty dumb. But if you decide to drink and drive underage, you could lose your license and your freedom. Underage drinking and driving. The ultimate party foul.
You are watching Germantown Municipal Television, your source for everything Germantown.
Welcome back to In the Money. If you're just joining us, we're talking about life insurance needs for you and your family. Today we're joined by Mark Wiseman with Agency Services. Thanks so much again for being here. When we left off, we were talking about retirement, sort of in your retirement window, the first few years that you're in retirement or right before, some of the things that you really need to be taking a look at. And one of those is if one spouse passes away, we know we're going to lose the lesser of the two Social Security amounts. The other would be if someone maybe in the military had selected early retirement, was drawing a pension, but it was based on their life only.
Right.
How do you assess the life insurance need on a case like that, where you know if one party, the party who's receiving the pension is going to pass away, what's that calculation look like?
Well, that we refer to that as a pension maximization situation. And the first step is to get all the forms in that the spouse elected at. A lot of times they don't know. You know, they were given the option and it's a joint survivor, or they saw the big number, which is their life only, and if something happens to them, the spouse gets nothing. You'll see that with teachers, you'll see that with FedEx employees, you'll see that with government employees, as you mentioned. So what we do is we get all the information in-house, and then we assess what the remaining payout would have been had they elected the joint option.
Okay.
And so what we do is we kind of back into that with the need. And so let's say that we can take $500,000 and turn that into an income spigot that would provide $36,000 for the life expectancy of the surviving spouse. If that's the case, that's the target amount that client should go to and try to purchase in the marketplace.
So if someone elected a single life only pension option because they were in a cash crunch at the time that they selected that pension, there is a solution for them to go back.
There is an option. The sooner we assess the risk, the better, because the older you get, obviously insurance charges get higher. So the earlier they can, and a lot of those are in their 50s, like you mentioned earlier in the segment. So in the 50-year-old, if we can catch them early, then they've got time to fund that. And we've done several executives at FedEx, several pilots over the years, several school teachers around town. And of course, our firm is licensed in all 50 states, so we work throughout the country.
So I'm glad you brought up health situations, because I know a lot of people probably don't even think about life insurance if they've had some sort of health event.
Right.
What can they do? Someone who maybe has had a heart attack or maybe cancer, how does the life insurance company look at those specific illnesses nowadays? Is there anything they can do?
Yes. Do not underwrite yourself. Okay, so step one, don't be the doctor. You're not the doctor, you're not the underwriter. We have medical directors that assess risk. I will say this, think about medical technology and the advancements and the drug therapies and the regimens, and just look at St. Jude in our community. When St. Jude's doors were open, the mortality rate was single digit. Now it's extremely high. And that's because of the advancements in medical care and in drugs. So what used to kill you 15, 20 years ago isn't doing so today because of the quality of care. So how that translates into insurance risk is insurance charges are less now, even for an older person. In the old days, you had basically 3 types of categories: Superman, Batman, and Spider-Man. I use that. That's just that's it. You know, it's a super plus, standard, and no, we don't want you. Today, there's 25 categories.
Really?
Yes, that you can qualify for. So we encourage clients to go back and look at their old policies. If they've quit smoking, if they've improved their lifestyle, there's actually a carrier now that gives you a Fitbit watch and will reduce your insurance charges based on your regimen, and you go right in and do it online and everything. So for all the gymnasts and the active people out there, you can control your own insurance costs, even in a life insurance policy.
That's fascinating. I know a couple folks around town, or if they don't have their Fitbit on, you know, the steps just don't count. So that's really interesting. Let's move on then to the risk of if you live too long. Right. What are the life insurance opportunities available to someone as they look at maybe outliving their money?
Well, that's a real concern today. When we do seminars, as I mentioned, we go in and train financial advisors, CPAs, and planners. That's one of the top concerns for their clients is, okay, I built $1 million nest egg. I didn't die too soon. I'm still fairly healthy, but what if I live to my early 90s or something? You know, I've got longevity in my genes. There's actually some special products out there in the insurance community that can help you add income to your lifestyle, whether you're 80, 85, 90, after you've used all of your 401k or all of your IRA. There's a carrier right now that you don't have to die and you don't have to get sick. You just got to call them if you're 85, and they'll let you draw down the death benefit over a period of the next 10 years. Now, some of that would be taxable. One of the huge benefits for life insurance and disability and long-term care is everything's tax-free to the beneficiaries. But if you draw down this as a normal investment asset, some of it would be taxed, some of it would not be taxed. So there's all kinds of options out there.
So in that scenario, if you draw down on the death benefit and then you pass away, is that a situation where the death benefit is gone, or you get a portion of whatever wasn't taken from the death benefit?
Portion, dollar for dollar drawdown on that.
Okay.
So that's how the chronic illness, and we'll talk about that in a minute, works as well. So there's a lot of options out there for the clients today. Whereas 30, 20, 15, even 15 to 20 years, they had no such options on policies today. So that's why we encourage the reviews that we mentioned in the first segment.
So as longevity increases, you've seen a response
by
from
the insurance
industry.
community, yes. Absolutely.
Awesome. Well, we'll get to longevity concerns and illnesses when we get back. Okay. We have to take another short break, and we'll be right back with Mark.
Taking care of a family member can lead to plenty of questions. Fortunately, there's a place to get the answers, for them and for you. Find articles, tips, and tools from experts and others who have been in your place. The Caregiving Resource Center at aarp.org/caregiving.
See on page 4 that the projections need to be tornado next Thursday.
Seriously? Thursday? Can't do that.
This is really inconvenient.
I have yoga that day. I have no time for this. So.
I can't do Thursday, but I can do Friday.
Disasters don't plan ahead. You can. Talk to your loved ones about how you're going to be ready in an emergency. Don't wait. Communicate.
Watching Germantown Municipal Television, your source for everything Germantown.
Welcome back to In the Money. We're talking through life insurance for you and your family. Thanks again for being here today, Mark. When we left off, we were talking about risk. We had previously talked about if you die too soon, if you live too long. Let's delve into if you get sick along the way. I know that's something that the industry has had to respond pretty quickly to, as there has been a growing issue with people getting ill in their retirement years and really before. So how do you approach trying to help someone plan for critical illness in all the different years of their life?
Another great question. I think if you look at it from a pre-retirement risk and a post-retirement risk, that's where you look at the difference. The pre-retirement risk is going to be the paycheck protection with the professionals, with physicians. If you take a physician today, they go to UT, they do a fellowship, they spend half their life learning to do a very unique specialty. They have to protect that. And one way to do that is through own occupation or a specialty definition of disability insurance. Now, as they protect that and as they grow a nest egg and as they pay their bills and send kids to college and buy a house and do other things, then they're building that nest egg up, and then they get to that 65 or 70 retirement age. And so I look at two ways that money is made. Man makes money, or woman makes money, and money makes money. Okay. So
takes money to make money.
That's exactly right. So once you get into that, you've had enough savings or you've got a nest egg built up. What's one of the greatest risks to that nest egg? And that is a chronic illness such as dementia, Alzheimer's, or any type of cognitive impairment. I mentioned the sandwich generation. I can't go to a seminar today, and I would say 80% of the time the hands are raised when the question is asked, are you caring, or do you have a close one that you're caring for? And if that's the case, where are the funds coming from? So the insurance community, back in 2006 through the Tax Reform Act, they codified, everything became very crystal clear. The definitions of what care was, how to qualify for the care, and the policies all became very, very streamlined.
Okay.
So, which is good for the consumer. So what that means is, as you approach retirement, you're not disabled, you didn't die, you don't want to get sick and have to, let's say, sell a bunch of assets to take care of oneself. The life insurance policy can add a rider now that will allow you to draw down that dollar for dollar benefit to pay for the care. You don't have, and the caregiver can be your own loved one's spouse.
Really?
Yes, you do not have to have a qualified caregiver. So that's a lot of people like that feature because your first line of defense is usually a loved one.
Now there must be some sort of restriction or some process to ensure that, family member.
Abuse.
Yeah,
Right.
yeah. So what is their process for knowing when care is required and that a family member is delivering that care?
The gatekeeper clause.
Okay.
So you have to be prevented from performing 2 out of the 6 assisted daily living functions,
Okay.
which are bathing, toileting, dressing, continence, and transferring, or suffered from a cognitive impairment such as early stage Alzheimer's or dementia or a stroke.
Okay.
And one other huge benefit of that is those benefits are also received tax-free, and they can be given as cash. Some carriers have reimbursement models, some have cash. So,
and I do see that come up a lot in my practice. So the benefit of direct pay to the carrier over cash, it's a lot more time consuming, right, to have to get reimbursement back. So in a reimbursement situation, tell me a little bit about what that looks like.
well, they will have a care coordinator, whether it's indemnity or reimbursement, but what you'll have is, let's say you or you have somebody come in and cook for you or clean, and they will give you a bill. That bill is then sent off to the carrier. The carrier can pay direct. You can have assignment to the institution or to the facility, or you can have it come through you and go. But either way, it is a little bit more cumbersome. It's just like keeping up with receipts if you go on a business trip, versus, just paying the bill.
Yeah, yeah. So are there policies that will pay you benefits whether you're actually receiving a bill or care? Are there policies that will just send you a check for, say, $3,000 a month, whether you actually need $3,000 worth of care or not that month?
Correct.
Okay.
So you determine, because you're buying, you're paying the premiums on these policies, so the contract is between you and the company. And that's why I encourage people that even have group insurance. You mentioned a statistic earlier about group insurance. Be careful with that, because that's a master contract between the employees and the company. Whereas when you buy private insurance for you, that's between you and the company. So to answer your question, it's up to you. So if you have a contract that pays $3,000 a month or $4,000 and you only need two, you just keep your bucket higher for future use.
Okay, so if you start off with a bucket of, say, $100,000, and you could take out maybe $4,000 a month, in those policies you could only take out maybe two, and your bucket would be available to you for a longer period of time.
Correct.
Okay.
Correct.
So it sounds like this is one of the features as you sort of go through and compare policies that you would want to take a look at. What are some of the other features of these types of policies that people should really have an eye on as they're selecting which product is correct for their situation?
Excellent. Let's say you get sick. Do you have to continue to pay the premiums on the policy?
Oh,
so there are such things as a waiver of premiums.
So that's not standard?
Not standard. You have to look at every contract. And this is what we like to do for our advisors and friends of the firm. We do the heavy lifting there. We sit down with the advisor and make sure that, what's your client looking for? Is it, are they extremely cost sensitive, or are they looking for maybe the Lexus? Are they looking for the Chevy? You name it, it's out there. And that's the beauty about the industry now. There are options.
Flexibility.
Optionality, yes.
Okay. What other things should people be on the lookout for on chronic illness? Premiums versus lump sum. I mean, there's just a lot nowadays to digest.
You can pretty much dial the plan you want with the options you want. There was a time when we had black Model Ts. That's all we had. That's the only car we had. It didn't really have a radio or anything, and I don't even know if it had a spare. The insurance industry was very similar. The product offerings were very similar. It's changed just like the auto industry, just like the computer industry, just like the phone industry. So it is a product to be consumed, and the value proposition is really when you open the hood and look under it, and that's what we do for clients and for their advisors.
So much like a car, we know we need one. We know we need insurance. So you're there to help us figure out which vehicle is right for all of us.
Right.
Awesome. Well, thank you for being here today.
Well, thank you for having me.
Yeah. Today we discussed how life insurance can be an important factor in protecting your family's financial plan, and that there are consultants like Mark and calculations that can be run to ensure that your family has the coverage required to meet your goals. That's all the time we have today. Thanks to Mark Wiseman with Agency Services, and thank you for watching. If you'd like to see more shows, follow us on YouTube or Facebook at Germantown Municipal Television. You can also visit our website at gmtvonline.org. Each person's financial situation is unique. Before making any decisions, please speak to a financial professional to see if our discussions today are in your best interest. We'll see you next month. I'm Teresa Bailey, and now you are in the money. And then we'll just chit chat.